Hi students, welcome to Amazing Accounts. Today we'll be catching up on weighted average cost of capital. So WACC is basically when you assign individual weights to specific elements of capital and multiply it with the individual cost of capital and then aggregate it, then it is WACC. So we'll just go with the questions. Today we'll cover 3 questions, 2 from your CMA study material and 1 from CA study material. I hope you've revise the topics and formulas from the previous videos. So we'll just go to the question. So A Limited has the following capital structure. So it has equity share capital, preference share capital, retained earnings, debentures and term loans. So further the information related to the market price of equity is given, the next expected dividend per share is given and the growth percentage is given. With regards to the preference shares, the number of years is 7 and the current market price is 75, which is your NP. And with regards to debentures, the number of years is 6, current market quotation is 90 and the tax rate is given. So the formula for KE is equal to D divided by P plus G. So you have to remember the dividend is given here 2 per share and price is given as 25 plus growth is 8%. What you need to remember is whenever they give the next expected dividend, then you will directly take it in your question. Whereas if they give the past dividends, then you will use the formula D into 1 plus G. So in this question, we'll directly go with the next expected dividend. 2 divided by 25 plus 8%, that is equal to 16. Next, KD. The formula for KD is equal to interest into 1 minus tax plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. So in this case, the net proceeds is given here as 90. Here 90 is given. Redemption value is not given in the question. So whenever the redemption value is not given, it is assumed that the particular instrument is redeemed at the face value. So the value of debenture is 70 lakhs. The number of debenture is 70,000. So when it makes the face value as 100. So your face value is 100, your net proceeds is 90, the number of years is 6 from your question. Tax rate is given as 50%. Sorry. So the formula is 14 into 1 minus tax. So interest into 1 minus tax. So you'd be knowing that all the debt instruments are tax deductible. 14 into 1 minus 50% plus RV is 100 minus 90 divided by 6, the whole divided by RV plus NP divided by 2. That is 100 plus 90 divided by 2. So I've just calculated it and it comes out to be 9.126. So one thing you have to remember with regards to the formula is that this particular division is only for this part, RV minus NP. So you don't do the whole division here. The below division is for the whole of the portion. So you just have to keep this in mind. The next formula, KP. KP is equal to the similar formula of KD, whereas there is no tax deduction portion in this. So it is preference dividend plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. So what is the preference dividend here? So when you go to the question, preference dividend, the details given are 12% preference shares. And the value of the debenture is, value of the preference share capital is 10 lakhs. Number of shares is 10,000. So the face value here also is again 100. The preference dividend percentage is 12%. So 12 into 100, that is 12% into 100, that's 12. And further the details related to it are N is equal to 7 and the NP is equal to 75. So putting it into the formula, it is 12 plus 100 minus 75 divided by 7 number of years divided by 100 plus 75 divided by 2. So when you just solve it, it will come out to be 17.8. The similar thing applies here also. The division is only for this portion, RV minus NP, and not the whole part. Further, what else is given here? Retained earnings is given and term loans are given. So you have to remember retained earnings, whatever is KE will be equal to my KR. So KE is equal to 16%. So my KR is also equal to 16%. Next, Term loans is 14%. So only thing you have to remember with term loan is equal to, term loan needs to be, term loan is also tax deductible. So when it is 14%, 14 into 1 minus tax, that would be 7%. That is all you need to remember here. So we are going to calculate the WACC based on the book value weights. So whatever is the book value, I have just given it here from the question. So the value of equity share capital, preference share capital, retained earnings, debentures and term loans. From my question, I have just copied this this whole portion. I've just copied this whole portion from the question, and then down I've given those, and then I've calculated the weights. So how do I calculate the weights? The weights are calculated as individual divided by total. So 100 divided by 400 will be 25%. 10 divided by 400 will be 0.025. 120 divided by 400. Likewise, I've calculated the individual weights, and then we've already calculated the specific cost. So we've calculated KE as 16%. So like I already told you, KR will be equal to KE, so it again applies here, 16%. Next, KP is equal to 17.8%. KD is equal to 9.126, which I have taken it as 9.13%. Next, term loan, like I discussed, term loans are also tax deductible. So 14% into 1 minus tax. So tax here is 50%. So 14 into 50%, that is equal to 7%, which I have given it here. Now what do? I find the weighted cost, that is weights multiplied by specific cost. So how did we calculate weights? Weights are calculated as individual divided by total. Total of the individual cost elements. So weighted cost is 25% of 16.25% of 0.025 of 17.8, and likewise I've calculated the weighted cost, and then I've aggregated all of this, and my weighted average cost of capital is 12.592. I hope we are clear with this portion. So all you need to remember is you calculate the individual cost with your regular formulas, and then for the cost of for the weights, what do? Individual cost of capital, the weights are calculated for individual elements, and then they are multiplied with my specific cost to arrive at the weighted average cost of capital. Let's go to the next question. Illustration 28 of your study material. The following is the capital structure of ABC Limited as on so and so date. So what have they given? They have given the values of equity shares, preference shares and debentures. Then what are they saying? They're saying that the market price of the company share is 110, and it is expected that a dividend of 10 per share would be declared for the year 2023, which means for the next year the dividend is going to be ₹10. And they've given the dividend growth of 6% in this case. What do we know? From this case, KE is equal to D divided by P plus growth, where you have D, P plus G. Further, what are they saying? If the company is in 50% tax bracket, compute the WACC. So what do? First, you calculate the KE. So the formula, as we have already discussed, we're just putting the figures in the formula. Dividend divided by price plus growth. So it comes out to be 15.09%. And if you go further, you don't have any other details for the other elements of capital. So what are we doing? We are going to calculate the WACC. So what is the equity share capital? The equity share capital, we have 5,000 shares. And what is the market price? The market price is 110. So we are going to calculate the WACC based on market values. So what do? Equity share capital, 5,000 shares into 110 rupees per share. The market value is 5,50,000. What is the cost of capital which we have found out? It is 15.09%. Next, regarding the preference share capital and debentures, we do not have any market value given for it, so we'll take as what is given in the book. But one thing what you need to remember is, always when you consider debenture, the KD is equal to interest into 1 minus tax. So what is the interest percentage here? The interest percentage is 12%, tax is 50%. So 12 into 1 minus tax 50% should give you 6%. Then how do we calculate weights? We do the individual divided by total concept. So equity share capital divided by total. 5,50,000 divided by 10,50,000, 2 lakhs divided by 10,50,000, 3 lakh divided by 10,50,000. You get the weights. And whatever the cost of capital for equity you found out, that for the other two they've already given in the question. So WACC is weights multiplied by individual cost of capital, and you aggregate all that, you get the WACC. But the question doesn't end there. You have a second part of the question. Assuming that in order to finance an expansion plan, the company intends to borrow a fund of 5 lakhs bearing 14% rate of interest, what will be the company's revised WACC? So they are telling they are going to take a new loan for 14%. So term loan is also a debt. So whenever there is debt, the KD would be interest into 1 minus tax. So 14% into 1 minus tax, which is 50%, should be giving you 7% interest. Then what else is happening? This financing decision is expected to increase the dividend from 10 to 12 per share. So the dividend is going from 10 to 12, and the market price of equity is expected to decline from 110 to 105 per share. So revising the formula of KE, dividend divided by price plus growth. Here growth is constant. So the revised dividend is 12, the revised price is 105 plus 6% dividend. So I am getting an answer of 17.43. This is the revised KE. Now what are we going to find? The revised WACC considering the market value. So what has happened? The number of shares remain constant, which is 5,000, but the market price per share has gone from 110 to 105. So 5,000 into 105 should be giving you 5,25,000. Preference share capital and debentures remain the same, but over and above this, I am having a term loan of 5 lakhs, which is incorporated while considering new WACC. What do I do for weights? For weights, I do individual divided by total. Individual divided by total, I find out the weights. And for the cost of capital, what happens? I am putting the revised KE here. Preference share capital and debenture have the same one, whereas long-term debts have a 14% interest. After tax, it should be 7%, right? So 7% interest. And for WACC, what do I do? Weights multiplied by cost of capital, and then I aggregate it. So I get up to 10.79%. So that's what the question. So initially the WACC is 11.52. After borrowing the loan, I'm getting a WACC of 10.79%. I think this question is clear. The next question, this is from the CA study material. It's a little tricky question, but I want you to know this question. We can expect such questions in your examination. So M Limited wishes to raise an additional finance of 10 lakhs for meeting its investment plans. It has 2,10,000 in the form of retained earnings available for investment purposes. So first thing what you need to remember is that whatever is the retained earnings would be a part of my equity. This you have to remember. We'll go further to the question. Debt equity mix is 30-70 respectively. So out of 10 lakhs, 30% is debt and 70% is my equity. And for debt also they have given a slab. So 3 lakhs is my debt, out of which 1,80,000. For 1,80,000, the KD is 10%, and beyond 1,80,000, it is 1,60,000. So we'll factor it in the question. EPS is given. Dividend payout is 50% of earnings. So 50% of earnings would be 2 rupees. Expected dividend growth they have given. Current market price they have given, and the tax rate they have given. What am I supposed to find out in this question? Determine the pattern of raising additional funds, post-tax average cost of additional debt, cost of retained earnings and WACC. So we'll go one on one. What is the pattern? So here already the pattern is given. 30% is debt and 70% is equity. So out of 10 lakhs, it would be 70% equity 7 lakhs, 30% debt, that is 3 lakhs. Over and above this, what do we already have? We already have a retained earning of 2,10,000, so which would be deducted from the equity. So 7 lakhs minus 2,10,000 will be 4,90,000. Balance whatever is the retained earning portion is given. Over and above that, we are totally raising 3 lakhs from my debt, out of which 1,80,000 falls in 10% slab and the balance 1,20,000 falls in my 16% slab. So this is the total funds and this is the pattern of it. Second, what is the question? To determine the post-tax average cost of additional debt, which means what is the KD formula? KD formula is generally interest into 1 minus tax. That is my formula. And they've asked the same question post tax. So what happens? KD is equal to interest into 1 minus tax. What is the interest percentage? We have already discussed. For the first 1,80,000 it is 10% and for the rest it is 16%. So 10 into 1 minus tax 50%. So tax rate 50% is specifically given here. So 10 into 1 minus 50%, that is 0.05 or 5%, and for the rest of the 1,20,000 I am borrowing it at 16%. So 16% into 1 minus tax, which is 8%. So these are the individual debt elements, individual KD elements. What is asked in the question is post-tax average cost of debt. So average cost of debt, what do I do? For each element, whatever is my cost of debt I am taking and I am dividing it by the total. So for the first element of 1,80,000, because we have divided into two parts of 1,80,000 and 1,20,000. For the first 1,80,000 it is 10% and post tax it is 5%. So 1,80,000 into 5% plus 1,50,000 into 8% because it is post tax. The whole divided by total debt. What is the total debt element? 180 plus 120, that is equal to 3 lakhs. So which is 6.2%. So what you need to remember is what is the post-tax KD and they've asked the average of it. Okay. So this is how you go about with this question. What is the third point? To determine the cost of retained earnings and cost of equity. So I think you would be knowing if KE is equal to something, then KR will also be equal to the same. So in this question, because it's a part of my equity funds. So what is the formula for KE? The formula for KE is equal to dividend divided by price plus growth. So here dividend is given for you. What is the dividend given here? Dividend payout is equal to 50%. 50% of the earnings. Earnings is equal to 4 rupees. 4 into 50% is equal to 2 rupees. But this is the current dividend. What do I need? I need D1. Future dividend I need. We have discussed this in the last question itself. When they give the future dividend, then you take it as is. When they give the past dividend or the present dividend, then past dividend, specifically when they give you the past dividend, what do? We do this D0 into 1 plus G. So D0 is equal to nothing but 4 into 50% 2 into 1 plus G. What is the growth percentage in this question? The growth percentage in this question is 10%. So D0 2 into 1.1 to 10% divided by what is my price? The price per share in this case, whatever they have given is 44 rupees. So 2 into 1 plus G divided by 44 plus growth. So you have to remember this growth, whatever is here is exclusive of whatever growth we apply it here. This is just for factoring the expected dividend. That is why it is D0 into 1 plus G. So you get it as 15%. So when my KE is equal to 15%, my KR is also equal to 15%. So now the last question is what is the WACC? So WACC is equal to, equity is equal to 7 lakhs, debt is equal to 3 lakhs. So how do we take the weights? Individual divided by total. 70 lakhs divided by 10 lakhs, 70%. 7 lakhs, 3 lakhs, 7 divided by 10, 70%, 3 divided by 10, 30% or 0.3. What is the cost of equity here? It is 15%. Cost of equity, retained earnings, everything is 15%, which is given here, and KD is equal to 6.2% for both. They've calculated it for both 180 and 120 individually, and then aggregated it. It is 6.2. Then you multiply them both and find out your WACC, which is 12.36%. So hope you've understood this question. So the major takeaway in this question is how they have allocated the cost of debt into two parts. For the total is given, out of which two parts are divided. Similarly, if there is a part of the retained earnings that is given in the question, which has to be subtracted from the total equity element, right? So the total equity is 7 lakhs, out of which 2,10,000 is reduced. So these are the two major things which needs to be remembered, and also this one particular how D0 into 1 plus G is given. When they have given next expected dividend, then you will directly take it in the formula, whereas when they have given you the past dividend paid, then what do you do? D0 into 1 plus G. So this is another thing which you need to remember. Hope you understood this. I'll meet you in the next videos. If you like these videos, consider liking, sharing and subscribing to our channel. All the best.